Hi everyone. So now we will start with ratio analysis. At a basic level, we have covered ratios where we saw that how ratios are useful in determining the relationship between numbers, how a user can understand numbers better by looking at ratio analysis. Now, ratios are used to analyze and interpret data for interested stakeholders. Now, when covering the scores, one important group of stakeholders are the shareholders of the company. So, from their perspective, we would want to see the general solvency and also the investment ratios. Investment ratios will be useful in determining the share performance in relation to the business. Right? So, now if I can say, we can divide ratios into four key components or different areas. Right? Earlier, we studied ratios from profitability and efficiency perspective and liquidity perspective. Now to that, we're adding two new areas over here, the gearing ratios and investment performance ratios. That's something we're adding new to this syllabus. When calculating ratios for profitability and efficiency, our main aim was to determine how much profit the business is making in relation to sale, and efficiency would determine that how efficient your resources or assets are in generating sales. That was the purpose of profitability and efficiency ratios. Then, if we can move forward towards liquidity ratios, liquidity and working capital ratios focused on the ability of a firm to pay off their short term obligations. We would see, does the firm have sufficient money to pay off its trade payables, bank overdraft, any other payables, and that money had to be paid from your current assets. So, working capital was the key concern over here for liquidity ratios. Now, when we move towards gearing and investment performance, when we talk about gearing, gearing is similar to liquidity, only the difference over here would be that gearing would focus on the ability of a firm to pay off their long term obligations. So, gearing would now see that does the firm have sufficient money to pay off their long term obligations? What are long term obligations? Do they have money to repay back to the debt holders? Any long term loan taken from the bank? Any debenture issue? Does the firm have money to pay back that debenture? Any other long term liability that is with the firm? We would want to see, does the firm have sufficient money to pay off their long term obligations? Right? So that's the focus we will have when we look at gearing ratios. Now, for investment performance, investment will be from the point of view of equity shareholders. So when we talk about investment performance, these ratios will focus for an equity shareholder to indicate how well the business is doing in relation to shares. So when a shareholder buys the share from the market, that's the investment we are referring to. So every shareholder want to examine the business performance because the return on investment is purely dependent on it. So if the firm does not have cash to survive, or the firm has too much financial risk, their return on investment would be impacted. Right? So that's the new area we would be concerned with, which is investment performance. Alright, so for ratios, we have to focus on these four key areas. Alright, so if we just briefly revise the key profitability ratio. Now, you guys should look at the previous videos over there. We have covered other profitability ratios, which include gross profit margin, operating profit margin. But the most important one that we have studied before is return on capital employed. Return on capital employed is a measure of how much return does every dollar invested into the business generate for the financiers. Who are the financiers or the capital employed is people who provide financing, which is equity holders, that is share capital and reserves, and your non-current liability holders, that is when you raise money through loans, debentures, etc. So these are the financiers, which is called capital employed. So we examine the capital employed and their return is operating profit. Operating profit is the profit that the business generates after paying off all costs, the trading cost and operating cost. That's the money that the financiers would get. So we take our operating profit and we divide it by capital employed times 100, which gives you the return on capital employed. So very often across questions, you can be asked to calculate return on capital employed. So make sure you guys remember return on capital employed. All right. Another way to calculate capital employed is that if you do not have this information, you can calculate it using all assets minus current liabilities, because we're rearranging our accounting equation. So that's just rearranging this equation, which is assets is equal to equity plus liabilities. So if you're looking to find equity and non-current liability, you can solve it another way by taking this on the other side, which is why this becomes assets minus current liability will also give you capital employed. All right. So for profitability ratio, besides gross profit margin, markup, operating profit margin, even for efficiency, we have seen the non-current asset turnover. You guys should remember how to calculate return on capital employed.